News headlines read, Fed, big rate hike, recession looming big layoffs in tech, stock market crash. If you check the indexes, you realize that indeed, Nasdaq has corrected 33% for the entire year. S&P 500, 19%. However, I'd like to point you to somewhere, to an index actually that doesn't seem to care what all these headlines are mentioning about, what Fed rate hike nonsense. This index is the light blue one at the bottom. You realize that it's flat, correct? Unscathed, correct? Today, I'm going to share with you what I've discovered, that we've all gotten it wrong. It's not going to be a global financial crisis engineered by Fed. It's in fact a tech-specific crash. Continue watching on if you are curious to find out. Hi guys, welcome back. Without further ado, let me share with you what that index exactly is. And it is actually the Dow Jones Index. Okay, Dow Jones has been flat, but why? Let's look firstly at what Nasdaq's top holdings are. You see Microsoft, Apple, Amazon, and Alphabet. I'm using, of course, the QQQ ETF, which tracks Nasdaq. Then what about for S&P 500? Let's look at the top holdings. You'll see again Apple, Microsoft, Amazon, and Alphabet. Of course, Berkshire Hathaway is inside. Very similar, correct? No wonder when one came down, the other also fell. Then how about a more diversified index? Let's look at the ETF that tracks the World Index, IWDA. You realize again the top holdings are Apple, Microsoft, Amazon, and Alphabet. Diversified globally, but actually you see the top holdings looking exactly the same again. You know, a world index top holdings are still 2/3 US based because they are still the biggest companies in the world currently. And if we were to plot all of them on a chart, you realize a big starting discovery. IWDA and S&P 500 track so closely together, they look almost identical. They are the light blue line and the orange line. So again, coming to here, make sure you understand that if you buy SPY and you buy IWDA, there's almost no diversification achieved. But what is the main message I'm trying to drive home for you today? Is the yellow line Dow Jones. What is it exactly telling us? Now to answer that question, we have to look again in the allocations for Dow Jones Index. Dow Jones is a very different index from S&P 500 and Nasdaq, which is market cap weighted. Dow Jones is a price index and it tracks 30 biggest companies. And you'll see the top holdings are United Health Group, Goldman Sachs, Home Depot, and McDonald's. And if you were to plot Dow Jones with S&P 500, you realize something. While technology is there, the biggest allocations for Dow Jones is in healthcare at 21.4%. Next up is financials at 16.14%, followed by industrials at 15.17%. So it's not technology, but rather healthcare, finance, and industrials. Boring, correct? How to 10x? Now, I have two observations to share with you right now. And before I get there, help me smash the like button so that you can share this message with a bigger audience to really educate them ahead of time what may be coming up for 2023. And as always, smash the subscribe button if you like content like this, because I do have even more material that is going to come out in the next few weeks relating to this topic. And the first observation is, global diversification is not working. Everything has gravitated towards technology in this last few years because of the run-up in market cap. What you need to understand is you need to tilt more heavily towards sector diversification. And to illustrate that point, I have a few graphs again to share with you. This over here is what happened, the recent run-up in tech represented by Nasdaq. That is the blue line over there, and below it is the purple line, Dow Jones Industrial Average. You see that the outperformance is massive, correct? No wonder everybody is so excited about technology, and no wonder every YouTuber is also mentioning favorable things about buying this dip in tech. Let's now look at what happened during the 2000 dot-com crash. Over there, the light blue line, that again is Nasdaq, and the purple line is Dow Jones Industrial Average. You realize that this time the dot-com bubble run-up was even steeper. Crazy, correct? Like 3 times the pace of what we've seen. But nonetheless, both of these indexes trended up because they still share a little bit of similarities. Microsoft, for example, is reflected in both of these indexes. I have at the bottom green, you see, that is actually Singapore's index, which has nothing to do with US and technology. Now let's move this graph to the left and bring up both of these to compare. What do we realize? There's this saying that history does not repeat itself, but it rhymes. You realize that the run-up in Nasdaq looks very similar. It's kind of abandoned other countries' indexes, and even Dow Jones has failed to keep up with it because it was way more sector diversified. So next logical question is, what can we learn from the dot-com crash, correct? I have for you a chart because this is the reality we are facing right now. You see that nasdaq has corrected severely, 33% for the entire of 2022. Dow Jones Industrial Average has held its own. The green shaded area over there is Singapore's index, where it actually clocked a positive 4+% for the entire year. So this is a bitter pill to swallow, especially when some people took foreigners' advice to switch out from Singapore equity to go into nasdaq. Let's look at what happened in the dot-com crash. You realize that the run-up was steep back then, and the correction was just as steep. Dow Jones Industrial Average again held flat. And if you were to shift this to left and piece these two graphs together, you realize certain similarities. There's a run-up in technology and there's a crash in technology. And at this moment, it seems that nasdaq is destined to underperform Dow Jones at some point in 2023. Will it reach back to levels before COVID? I think if history rhymes again, that could jolly well play out. Because if we look on the left, you realize that nasdaq has actually corrected not just its 1998 to 2000 gain, it's even reached levels previously seen only in 1997. If that were to play out this time round, you realize that nasdaq's correction could still run quite a lot more. Looking back at this whole entire few years, I think it's quite clear for us to conclude some things. It is not industrials, it is not banking, it is not energy that's benefited from 0% interest rates. It is quite plain and simple technology. Because technology companies were able to scale at 0% interest costs, and they were the ones that registered the biggest growths seen across all sectors. That leads to the second observation that I have to share with you today, which is value investing and dividend investing has already outperformed growth investing. Forget about going to the moon. Future generations will laugh at us just as how we will laugh at the investors who have suffered in the dot-com crash. And to drive home a point on value investing, take a guess which is the best performing technology company. The surprising answer is actually IBM. The oldest technology company, some people like to use the slang OG, of technology. So it's indeed quite a big surprise how markets tend to humble us. Today's video is sponsored by Webull, and if you'd like to do dividend investing, you can actually check out Swap US Dividend ETF. Again, anything mentioned over here is not investment advice. This is one of the better known ETFs that invest into dividend companies listed in US. Then what about for sectors in the energy space, because we are looking for diversification, correct? So one idea is actually XLE, Energy Select Sector SPDR ETF. The top holding of this ETF is actually ExxonMobil. And last but not least, if you like to invest into a stock which is much more diversified than S&P 500 itself, look no further than Berkshire Hathaway. Of course, top holding is still Apple, but Berkshire actually has energy and industrials within its allocations. So as always, if you are new to the platform Webull, now have a sign-up offer, especially for you, whereby you can get free vouchers, simply make a deposit of $2,000, perform at least one stock or ETF trade and one mutual funds trade. That in itself will get you that $50 worth of trading vouchers already. And do know also Webull charges $0 in commission, so if you're keen, look for links below, and thank you again for supporting this channel. Today's topic is on why we've gotten it wrong and it's not going to be a global financial crisis engineered by Fed. It is a tech-specific crisis. And I also like to conclude with these two very important points. Hopefully they are useful food for thought for you. The first quick conclusion or action step that you need to think about is this could be a quick recession and not a global financial crisis. Because in global financial crisis, we saw banks collapse, we saw liquidity dry up, we saw bankruptcy being pervasive. But right now, that doesn't seem to be taking place. Which means if we were to pull up a world GDP growth chart, you realize that global financial crisis saw big drops, in fact negative growth for a couple of years, correct? Unprecedented pain. But if we were to look in dot-com crash, you realize that growth dropped but did not even get to a negative space. Again, all the other industries are humming well. It's only technology is doing all the massive layoffs and massive cost-cutting measures. So if this were to play through, the idea of only investing in 2024 may be too late. You need to get the act together and start investing slowly right now. The second action step is to think very different about what could happen in the future, sentiment at least in the stock market. Let's look again at what happened in the post-dot-com crash. You realize that in 2002 to 2007, something happened. I'm mapping again NASDAQ, which is the blue line, Dow Jones, which is the purple line, more diversified in all sectors, and Singapore, which is a shaded green zone. You realize that NASDAQ continued to underperform for years, correct? Because when investors get hurt, they are fearful about returning back. And it's a bit like what China has experienced in the last few years. You'll be surprised to learn that back then, when technology's growth dissipated, investors moved on to the next growth story. And why exactly did Singapore's index do quite well, outperforming both of these? It is not that Singapore is so innovational, correct? Let me bring you back again to something that has happened back then, and that was China's growth story. Unbelievable, correct? Now you mention about it, people scoff at it. But back then, 2005 to 2008, that was the rise of BRIC, Brazil, Russia, India, China, of all developing economies, and Singapore was a natural beneficiary of that growth. Take note again, history may not repeat itself, but history may rhyme. There will be a new place that is unexpected, that will be growing faster than what people have foreseen, and it will be the next story of growth that draws new investors' money. Unbelievable, correct? Smash the like button and keep that in mind. Invest safely for 2023. I wish you all the best, and check out some of my previous videos which can help you further in your journey. I'll sign off from here. Take care and goodbye.